What in the heck is going on with the real estate market right now? And more importantly, what's up with all these crazy interest rates? Well, my name is Jonathan Big Country Richards, and I'm your local Central Texas, Austin real estate expert. Let's dive in. So one of the hottest topics out there right now is what's going on in the real estate market, more specifically on the lending side with interest rates. And so today I thought it'd be really cool, and I'm super excited to have a really good friend of mine who is a local lending professional here in Austin, Texas, come in and talk a little bit about lending, the mortgage process, what it's all about, and what interest rates are doing right now. Maybe you can even give us a little prediction. We'll talk about that in a minute. Sure. But this is Josh Flores. Josh is with Supreme Lending. Josh, tell us a little bit about who you are, who you work for, and why mortgage.
Yeah, absolutely. So my name is Josh Flores. I've been doing lending here locally since I finished college here. So I went to St. Edward's University, graduated in 2002, and then kind of randomly came into mortgages off a business degree and never left, right? I always enjoyed it. It was a fun industry to be in. And so, you know, I've been in the business a long time, coming up, I guess I'm 22 years coming up, I guess. I now work for Supreme Lending, have so for almost 16 years now. I'm a branch manager of the biggest branch in Central and South Texas, but spend a lot of my time dealing with clients, right? Managing some, but for the most part, being a loan officer is what I do during the day. So.
Absolutely. And this is Texas at its finest, guys. By the way, if you don't know, this is Central Texas weather. It's like 85 degrees. That's why we're on a patio today. That's why we're having a cold beer. Josh and I get together a lot and have a cold beer and just talk about real estate because, well, we're kind of nerds, but also too, like, this is our livelihood and it's what we're passionate about, and we love helping other people. And so let's just dive in. First and foremost, I do want to talk about interest rates, but before we get to that, one of the biggest questions I always get from potential borrowers or buyers, I should say, is what is the loan application? Like, why is it important for me to go get pre-qualified from a lender? What does that process look like? What all is it that you're going to be looking at through that process? And maybe also tell us the difference between a pre-qualification and a pre-approval.
Yeah, so a lot of people come to me and they just say, hey, can I get a mortgage? Right, and that's such a
I want to buy a house or something.
Right, it's such a complicated question because can you? Probably, right? But what kind of mortgage? What kind of down payment? What kind of interest rate? What kind of loan program, right? Mm-hmm. Do you have down payment? Do you not have down payment? There's so many different mortgages out there that a lot of times people are, to be honest with you, a little bit worried or scared, if you will, right, of getting doing an application because they think, what if they tell me no?
Yeah.
Right? And here's the thing. So with Supreme Lending, whenever we pull a credit report, it's a soft pull. So it's not even a hard pull on your credit. But more importantly, we're trying to get all of your information so we can understand what kind of programs that we can put you into, right? And from there, we can talk about payments, we can talk about down payments, and the real information that you're looking for. Because as a lot of people know on the internet, you can go and look on the internet and they'll say, oh, there's $1 million house and the payment's only $200 a month, right? Sounds too good to be true. Likely is too good to be true. Right. So that's what's so important about getting an application and getting pre-qualified, right? So there's a difference between qualified and approved, right? So pre-qualified is we're getting an application on you, we're collecting some documents from you and making sure that what you put on the application is accurate to what we're seeing in real life, right? Pre-approval is where we actually submit you to an underwriter and get them to actually give you the full cert of approval. Hey, we're good. Now we're just lacking a property at this point because we also underwrite the property, which is what we call the collateral of a loan, right? Mm-hmm. So once you're pre-approved, it's even further down the process where you can be super confident that I know there is almost nothing that's going to stop me between starting a contract and closing.
Gotcha. So let's dive into that just a little bit because I have two specific questions. Number one, you mentioned soft pull and hard pull on your credit. Right. Can you tell us the difference between the two? And then the second part of that question, can you explain what DTI or debt to income? Everybody thinks that when you're qualifying for a mortgage, it's just about your credit score, and that's not it, right? I mean, there's money involved, and you need assets, and you need to make sure you can afford a payment. Can you explain a little bit about what DTI is and how important that is in qualifying for a loan?
Sure. So two very different questions. So soft and hard pull, what the difference is. So a lot of people have a big fear of pulling their credit because of what it will do to their credit score, right? That's called an inquiry. So when you have an inquiry, it can ding your credit score by just a little bit. Depending on how many inquiries you have, depending on what if you're trying to buy a car, trying to get a mortgage, trying to get a credit card, there's different types or classes of inquiries too. So there are some folks that will come up and they've been trying to get credit all over town, right? I've pulled credit reports literally where you had 90 inquiries in 30 days. That's pretty intense, right? Wow. That's pretty over the top, if you will, right? But to err on the side of caution, we do a soft pull. A soft pull gives us score, gives us history, gives us everything that we need, and our company can actually run approvals based on a soft pull. So there is no inquiry, no hit to your credit, no worries, right? So that's the difference between the two. Now, once you get into the loan process itself, we'll pull an actual credit report, a hard pull, but 9 times out of 10, it's exactly the same. Exactly the same. So, and we're fine. It's a little bit of extra cost for us, but we're fine to do it for our clients because we know that matters for them.
Absolutely.
Right? And then your second question was in regards to debt to income ratio, or DTI is what we call that. So, yeah, I mean, like income, employment, assets, credit, these are kind of some of the biggest pillars that we're looking at when we're talking about approving somebody for a loan, right? So debt to income ratios, we break down all income to a monthly number and we break all debt down to a monthly number. You divide debt by income and you get a percentage, right? So the percentages can matter depending on what type of loan that you're looking at, but as a good rule of thumb, 50%, right? We're looking for your gross income, so not after-tax income, but your pre-tax income to be more than double what your debts are, right? So if your debts are half and your income's 100%, that's 50%, right? So that's what we're looking for in most cases. And of course, we're going to consider anything that we see off your credit report, like, you know, credit cards, car payments, student loans, whatever the case is. But there are so many different tricks to how we look at certain debts, right? And I'll talk specifically about like student loans.
Mm-hmm.
Okay?
This is like the hot topic.
Conventional loans, FHA loans, down payment assistance, all these guys look at debts differently. Sometimes student loans have zero payment because they're deferred. Sometimes they have income-based repayments. Sometimes they have what we call fully amortized payments, right? So there's all these different ways that we can look at it. So some people think, oh my gosh, I've got all these student loans. There's just no way I'm going to qualify.
Right.
Let us know. We'll talk to you. We can even advise you on how to set up income-based repayments. So maybe you can pay a little bit less there such that you can get a home, make a ton of money on the house, right? And then we'll switch your payment back later,
sure.
right? So there's just a lot of advice. There's a lot of things and tricks and that people just don't know, right? If you don't do this for a living, you just don't know, right?
So having a lender that can be creative is probably, you can take a sip.
You want to sip?
Let's sip, man.
My mouth is a little parched.
Let's go. Let's go. So having a lender that can be creative is really important as well, and somebody who can actually take a file. It's not just a bunch of paper. You got to actually go through it and put the puzzle pieces together and go, okay, if I put this here or this here or this here, it's a more valuable solution to my client, and they're going to be able to get into that home versus, oh, sorry, we can't get you because of just the basics.
I mean, it's such a big deal, honestly. So, you know, a lot of people think, are all mortgage companies built the same? Are all loan officers built the same? And the answer is absolutely not, right? Absolutely not. There are some that are only looking for the cookie cutter, best credit, you know, good income, blah, 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 blah. They don't want to work hard, right? They don't want to work hard. But most first-time home buyers need somebody on their side. They need somebody to work hard. They need somebody to look past what is just right in front of them and think, well, how do I get to that next step so that I can actually buy this house, right? Because buying a house is the first step to true building of wealth. I mean, it's such a big deal. I can tell you I'm a big market guy, I'm a big stock guy, IRA, 401k, I love all that stuff. I'm not saying anything bad about it, but if you don't have real estate, I mean, you're
you heard it here first. You guys hear me talk about it all the time, but he just said it.
Big piece of the puzzle.
Yeah,
big piece.
Absolutely. So last question, and then I want to move into interest rates and kind of that, because we're talking about creativity. But one of the biggest misconceptions or myths that I hear from buyers is I have to have 20% down to buy a home.
Right.
And that's just not true, is it?
It's just not. It's just not. And I could go into the history of that and bore you with a bunch of historical stuff, but the answer is no. Right. Absolutely not. The more you put down, does it benefit you in some way? Yes, absolutely it does. But if you don't have, let's just say you have no money down. I have literally $0 to put towards this, right? There's down payment assistance programs. The government has several, like state and federal, have several programs because they know that getting people into a home is what truly starts building wealth and building stability in a family, which benefits everybody, right? Not just them, but everybody around them, all the shops around them, the businesses around them, right? Like, it is a big deal. So there are down payment assistance programs that will cover all or most of your down payment. They can even cover closing costs. There's ways to like set up a real estate contract to cover some, and then the down payment assistance covers others. There are so many different options. The point is, though, you have to qualify for these different programs. So we have several of them out there: county, state, federal, all the above. And then that is another puzzle. What works best? How do we put all these things together to get you the most benefits that we can?
And it's free money in most cases. A lot of times you don't have to pay it back.
And in most cases, as long as you stay in the house for at least 3 years, you never pay it back.
Who doesn't want free money?
There's grants. There's grants that don't matter how long you stay in it. There's some that require 3 years. There's a whole different number of grants out there. But we talk to you about what your plan is, how long you'll be there. Like, so if you have the guys that are trying to flip houses, right?
Right.
Down payment assistance is not going to work for
Probably
them, right?
not, no.
Those guys are investors. That's a whole different market, right? But we're talking about people that are looking to buy their first home for their family, trying to get their family into a home. That's what these programs are for, and they are so valuable. We do a ton of those. We're one of the biggest down payment assistance lenders in Austin.
Wow.
Yeah.
That's crazy. Well, let's have a sip, because we're about to talk about interest rates, and I feel like maybe we need a sip of beer for that.
All right, let's do it.
So, obviously right now, the hottest topic that's out there is the economy, it's interest rates.
Yes.
There's a lot of talk about the Fed rate, which a lot of people confused with all different types of rates, right? And the Fed rate is kind of in and of itself its own little thing, right? Let's just start with an explanation of what that is. So, you know, we hear more about the Fed rate. Tell me what the Fed rate is, what it means to different loan programs, but more specifically, how does it at all affect the mortgage interest rate market?
So the first thing you should know is the Fed rate is not the mortgage rate, right? So the two don't operate side by side. Sometimes in some markets, Fed rate goes up, mortgage rate goes down. Sometimes it's opposite. Sometimes they go the same. So my point is, Fed rate is the rate in which banks trade money to each other, okay? So the big news about the Fed rate, and a lot of viewers probably know this information, but just to make sure we're covering all bases, right? Inflation was a big problem post-COVID, right? COVID, universal problem, totally unique, caught everybody off guard. They had to pump a bunch of money into the economy. Doesn't matter what side of the aisle in terms of politics you're on. The reality is they had to make a decision pretty quickly, and there was no time to be surgical about who gets money and who doesn't, right? So they just threw money out. They reduced interest rates during that time too. Reduced mortgage rates by pumping a ton of money into mortgage-backed securities, but also handed out stimulus checks, what's called PPP loans to businesses. What happens is when the Fed gives all this money out, basically it's not like they're pulling from their savings account and handing you money. They're printing money, right? So you're putting more money into circulation. And so when you have too much money chasing too few goods, that's where inflation comes. So everybody knows inflation. Everything at the grocery store, everything that you were trying to buy got insanely expensive about a year and a half ago-ish. Probably more than that, probably 2 years ago, but they just started doing something about it back in, what was that, 22 May-ish, April, May, something like that. So they raised the Fed rate. The idea is it slows the economy down. Everything becomes more expensive. So a lot of the money rolling around in businesses and whatnot, most of it is borrowed. A lot of people don't realize that. Most of that money is borrowed, and that's what allows businesses to grow. Well, if they can't grow, then they can only work with the clients that they have. And if you have a bunch of people, the biggest thing I always talk about is pools, swimming pools, right? Swimming pools doubled in cost during that whole inflationary time, which was crazy, right? So everybody thinks, oh, we have 8% inflation, but there were things that were doubling in cost, right? And so the reason being is they had too many clients, not enough business, right? And not enough people to do it. So they said, all right, well, we're going to start charging more. Well, people started paying it, right? So the government realized everything from eggs to swimming pools was getting more expensive. And so they raised the Fed rate to offset inflation. And they've done that, and now they've got inflation rates down, depending on the metric you look at, anywhere between 3 and the high 2s, something like that. Their goal is 2 at this point, so we're very, very close to that. But they've paused on raising rates at this point, which is good. That means we're stabilizing, and now we're going to start to float down. They don't want the rate as high as it is. They want it to come down a little bit, right? So as it starts coming down and money starts loosening up, we should see mortgage rates fall along with that, right? Again, Fed rate, not the mortgage rate, but we should see the two kind of follow suit is the idea. So
let's move into mortgage rates. Tell me where we came from, why the rates went up the way they did, which I think we kind of covered in inflation, but maybe just explain that a little bit, where we're at right now, And I know we don't have a crystal ball anymore, but maybe give us your opinion about maybe where you think we might be headed.
So, as the saying goes in our office, our crystal ball has a giant crack in it a long time ago. There's just been some major events, right? COVID, some of these things are completely out of the blue. Nobody would have ever expected COVID, let's say that, right? So here's my prediction, if you will. So my prediction is the reason rates went up was because of inflation, and they will come down. And so that's what you're asking, right? Where rates are going. We've all been kind of sitting around wondering when inflationary numbers on average over a year-to-year period will come down enough where the Fed feels comfortable bringing rates down. And again, they've gotten pretty close to that. So the idea is they're going to start coming down. We feel like it's June or July, okay? But here's what everybody needs to understand. That values on properties, more specifically sales prices on properties, have come down pretty dramatically, okay? So, and when I talk about this, I may sound a little frustrated because I've had this conversation so many times, but what people need to understand, let's just say your payment is $500 more a month. Let's just say some outlandish number, $500 a month. Per year, that's $6,000.
Right.
You're a realtor. You want to do a $6,000 negotiation on a contract? How long does that take?
Quite a while, actually.
Well, my point is,
not the answer you wanted, but
no. But my point is that sales prices have come down, and sellers. Okay, back in 21, right? Sellers, it was a seller's market. They got everything. They weren't paying any closing costs. They weren't paying any realtor commissions. They weren't paying anything, right? Now it is flipped to a buyer's market where values come down, and you can get a sales price, $500,000 house, you can potentially get for $450,000, $420,000. Right? Yeah. But you were having to pay $600,000 because you were having to offer more.
Sure.
And what I tell people is, like, the difference in a mortgage payment, I don't care if you're at 3%, it doesn't matter. You're paying far more for that house back then. That's great, you got a 3% rate, but it doesn't matter, right? Everything we do now will be refinanced in probably 18 to 24 months. Right? So, as the saying goes, and I know a lot of real estate people have heard this, you marry the house, you date the rate, right?
That's
right. I mean, but it's true, right? And I know it's a used up saying, but the reality is you can refinance as many times as you want during that process. And I can tell you we're paying all closing costs to do so. So even when you buy, there is no increase in loan amount because of closing costs. We'll keep your loan amount the same and just buy down your rate.
Yeah, and what you're talking about there, and I'll go back to my answer on that because I was being a little sarcastic, but the point is that we're in the type of market right now, inventory-wise. Usually you have a buyer's market and a seller's market. Basically what you're saying, house prices have come down, there's a lot more negotiations that can be done, and sellers are a lot more willing to give up seller concessions to help pay for closing costs and things of that nature, or even rate buy downs.
Interest rate buy downs.
So tell us, let's talk about that. What is a 2-1 buy down? Why is that so popular right now?
Well, okay, so why was it not popular before? Because sellers were not willing to pay anything towards a buyer, right? Now they are. So you can get temporary buy downs, which cover you for the next 1, 2, or 3 years, okay? So if you get an interest rate buy down that covers you for the next 24 months, you can move your rate down 2%. So let's say your start rate is 6.5, you go down to 4.5, okay? 4.5 is an excellent rate. 5.5 after a year, that's 6.5 on the third year. So the average rate is much lower, and the idea is as rates calm down, we'll refinance you midway through. Right?
And you're not in a buy down situation, you're in a permanent fixed rate.
And the cost of this buy down is whatever that savings is. So let's say your start rate is 6.5, whatever your payment is there versus 4.5, right? The seller's gonna pay the difference for that first 12 months. Second 12 months, 5.5 versus 6.5. They pay that difference. They put that money in an account, okay? So even if you say rates all of a sudden drop for some weird reason, right? Some weird economic or global reason, right? They drop, that money's still yours. It's not like you put it there and you're never getting it back. It's still yours. If you refinance because rates all of a sudden magically drop to 3% again, you get it back in the form of a principal reduction. So if you owed, say, $400,000 on your mortgage and you had $5,000 left, you only owe $395 now, right? So when we refinance it, you get that money back. So there's just so many strategies that make buying a house now worth it, because when people wait for rates to come down, when rates do come down, demand will come back into the market and sales prices will go up. So now you're thinking, well, that's great, I get my low rate, but now I'm paying $100,000 more for the house, and it doesn't make a difference, right? It doesn't help you. In fact, you're hurting yourself.
Yeah, I tell buyers all the time, you know, if you're waiting for rates to come down, you're going to be waiting for probably quite a while.
Yeah, you're going to be
And if you're expecting them to come back down into the 2s and 3s like we saw over the last couple of years, probably not going to happen. And also too, Josh, I just want to say this, like historically rates have always been, we're still in a great rate market. I mean, even at 5 and 6%, I mean, if you look historically through time, even in the 80s, we were in the teens at the height of some of the housing market that was out there. Like, so I mean, I think, and you talk about this at Supreme a lot, that jobs drive housing, right?
Yeah.
As long as there's jobs and the economy is good and the unemployment rate, people want to buy houses. Interest rate doesn't really.
Just today, the jobs market came out. Just today,
it came down,
and we came way above the market, right? They had more jobs created than what they expected, right?
Yeah, and the unemployment rate came down, so that's good.
Yeah, exactly.
Yeah.
Exactly. So it is fueling. The market is doing fine, right? So it's such, and that's what, again, I don't ever want to sound frustrated about it, but when it, again, if you're like a house flipper, totally different conversation, right? Most people buying houses are going to be there 5+ years, okay? So you have to get in the market. You have to get in the game. Otherwise, you're never going to win, right? These people that say, well, I'm going to wait. Well, then the house ends up $100,000 more.
Yeah.
And like, you can't buy the house again. You can only buy it once, and you got to buy it low, and now's the time to buy it low. And it doesn't matter if you buy now or 6 months or 12 months from now, you are likely going to refinance every one of those loans as rates come down.
Absolutely. Well, Josh, thanks for all of that, man. That's a lot of information that we just dumped on you, but it's really good information, and it's a conversation that if you are in the market to buy a house, or maybe you're relocating here to Central Texas, that you need to have. And it's so important that you hire the right team, that you have the right professionals on your side, you have a good lender that knows what they're doing, that can be creative, that is there for you. You're not just a loan number or a file number, you're a person or a family, and I know that's how you guys treat some people over at Supreme Lending. That's why I use these guys for my clients. It's really, really important. So do me a favor, if you haven't already, subscribe to this YouTube channel. Let us know that the content we're bringing you is good and invaluable, and we want to keep bringing it to you, and that's really important for you to do so. Josh, before we go, I'm going to put your email in the video here so people will be able to contact you. Any last advice for a home buyer that's out there that's thinking about buying right now? What's your advice for them, or a tip or trick or something that they can be doing right now to prepare themselves to buy?
To prepare themselves to buy, I mean, the standard is, you know, when it comes to credit, obviously keep things going well, right? No late payments, anything like that. Save up money, right? And I'm not even saying for the mortgage. I mean, when you buy a new house, there's an infinite amount of things that you want to buy inside that house, right? So it's always a good idea. But more importantly, just find out, right? If you're on the fence, find out. Find out. Just make a call. There's no commitment to buy. You can do an application. You can go through the whole process. And just know, defining it as an option will all of a sudden put it in your mind that, yeah, maybe I can do this, right?
And sometimes just having that conversation, even if you're 12 months out, like I know I've sent people to you before that have been 12, 24 months out sometimes, but you take the time to have that conversation so they know what to do to prepare and the steps that they need to take in order to get in. And that's, again, another reason why you want to make sure you have a good team of professionals on your side. Well, thank you so much, buddy. I really appreciate you. You're an incredible guy, an incredible lender, and I'm so grateful for you and all the service that you give to the homeowners here in Central Texas, guys. Again, my name is Jonathan Big Country Richards. I'm your local Central Texas, Austin real estate expert. I'm here with Josh Flores with Supreme Lending. And until I see you again, be epic, be legendary. Big Country out.